There are two ways out. You can have an honest default. That takes you right straight to the 1930s. It's pretty ugly. Or you can have a dishonest default. And that's what we're going to do. We're going to have a dishonest default. In a dishonest default, you honor the nominal value of the obligations. You tell some old geezer named Rick Rule, yeah, we promised you $4,000 a month in Social Security payments, and you're going to get it. It's just that we're going to devalue the dollar. So your $4,000 is going to buy you $800 or $900 worth of goods and services. Mm-hmm. Becky, we did this in the decade of the 70s. According to the Congressional Budget Office, the US dollar lost 75% of its purchasing power in 10 years. And I think that's what we do today.
In the 1970s, the US dollar lost 75% of its purchasing power, and Rick Rule says we're about to watch history repeat itself. But this time, it's worse. The US government is staring down $36 trillion in on-balance sheet debt and over $100 trillion in unfunded liabilities like Social Security and Medicare. The math doesn't work, and Rule says they know it. That's why Washington isn't planning to default honestly. They're doing it dishonestly. They'll keep mailing the checks, $4,000 here, $2,000 there, but that money won't buy you what it used to. Within a decade, your monthly payment could lose 80% of its real value. You'll still get paid in monopoly money. This is a stealth default, and Rick says it's already begun. Bond investors have figured it out. Foreign governments don't trust the dollar. And the Fed? They've lost control of the long bond market. The entire system is shifting, quietly, forcefully, and irreversibly. And if you're still holding cash, you're the one footing the bill. This is how governments steal from savers without ever passing a law.
The circumstance that we existed in the period, say, 1980 to 2020, while it was very pleasant, is over. That the demographic boom that we enjoyed is becoming a bust as my generation dies, literally. That the period of lower interest rates and US dollar hegemony is over. Nobody, I think, is suggesting that the world is going to come to an end, but we are all suggesting that the set of circumstances that we enjoyed for 40 years have changed, and we're going to have to adapt to that change. Certainly, one of the ramifications of that, one of the ramifications of a weaker US dollar, in absolute sense, maybe not a relative sense, but in absolute sense, is I think there's a consensus around the fact that gold will continue to do well. There has been skepticism about the gold price on and off for a very long time. People say to me now, gold's done very well of late. Do you think that's over? And I try to point out to them that in the decade of the 1970s, the last time that the US dollar enjoyed, if that's the right phrase, a precipitous decline in purchasing power, that the gold price ran 30-fold. And I think one conclusion that came out of that panel is that although everybody had different interpretations of the problem, interestingly, everybody had the same solution. I believe that tariffs are taxes, and I believe taxes are bad. He believes in high-quality people having more control over the economy, and I believe in decentralized control. Right. I would prefer that the big thinkers, even if I like them, don't control my life. I would prefer to make my own decisions. I'm not sure that those people in government who I have met are competent to have a master plan. My suspicion is that they take advantage of trends in motion to consolidate their own power. Very different than Jim's belief. I don't know why you would work really hard to devalue the dollar, although certainly Trump did say that a weaker dollar was good for some aspects of the U.S. economy. I'm not sure that you have to work real hard to cause the purchasing power of the dollar to decline. Given the aggregate levels of debt in society, it seems to me that the only way that you honor the nominal value of our obligations, which for entitlements alone exceed $100 trillion, without devaluing the purchasing power. You honor the nominal obligation of Social Security to an old geezer like me by continuing to pay him $4,000 a month or whatever it is they pay, but by devaluing the dollar. In other words, $4,000 buys you 10 years from now what $1,000 did now. We did that in the decade of the 70s, Danielle. I understand that you weren't there. I was. Over the period of the 1970s, according to the Office of Management and Budget, the purchasing power of the US dollar in an absolute sense, not relative to the Canadian dollar or the pound, but in an absolute sense, the purchasing power of the dollar declined by 75%. I think past its prologue. I think the only way that you deal with $100 trillion in nominal value of off-balance sheet liabilities is by devaluing the numerator, in effect. I don't see any way out. I don't think that we have the political will to say to old folks like me, yeah, you paid in for 60 years, but you're not going to get it. The only way that I see of honoring our so-called obligations is by de facto devaluation of them. By the way, I'm not saying that the US dollar will perform poorly against other fiat currencies. I don't believe that will be true. I think the US dollar hegemony will be reduced, but I don't think that we will substantially underperform a basket of other currencies. The euro, because of 13 participants, is a who owes you nothing, and the BRICS are nobody owes you anything. The idea that you develop an overarching convertible security currency out of a conjunction of non-convertible, illiquid securities is silly. The other thing is that the BRICS nations, while they don't trust us, trust each other a little less than they trust us. I learned that when I was selling Sprout products to global wealth funds, sovereign wealth funds. I'd ask them, why do you use U.S. Treasury securities? They seem like a lie. And I remember an Asian counterparty saying to me, yes, but a deep and liquid lie. And I said, do you trust us? He said, oh, no, but we trust you more than we trust each other.
They said that to your face.
To my face. We said it was inevitable, but not necessarily imminent. Now it's imminent. The increase in the gold price, the follow through from the increase in the bullion price to the increase in free cash flow among producers and the market reception to that means that now the change isn't merely inevitable. It has to happen. Now it's happening. Now we're in it. This precious metals bull market is following a path that I have observed in my life 3 times before. I've seen transition go from the metal to the best of the best. After it goes from the best of the best, it goes to the best of the rest. We are in a gold and gold equities bull market now. We're not waiting for it. We're here.
The Fed and the political class in the United States has been doing whatever they could do to jawbone rates lower. And by quantitative easing, you'll note that the Fed participated in their own auction last week. They've been successful in holding near-term rates lower, but they've lost control of the yield curve in the longer bond, which is difficult for them. Difficult for them in many ways. The political class, of course, would like Americans to have access to cheap credit. At the same time, the U.S. government has to roll over several $1 trillion worth of debt that they've been paying 2.5 on, and it looks like they'll have to pay 5 on it. If we're concerned about debt service, how are we going to feel about debt service at twice the current rate? An ugly circumstance. For a long time, the Fed appeared to have control of the yield. You have to go back to the Clinton era for the last mention of bond vigilantes, which is to say the market regaining control of the rate rather than the Fed regaining control of the rate. This is a truly interesting circumstance, and I don't think that the fact that it's occurring at the same time that the US dollar is facing a challenge from other fiat currencies in terms of hegemony is any coincidence. I think they're part of the same phenomenon. The US dollar, and in fact the US economy, was really a hegemon in the period 1982 to 2022. And I believe, by the way, that the US dollar will be the reserve currency for the balance of my life. For the record, I'm a very healthy guy. But I think that the hegemony that we've enjoyed for the last 40 years is gone. I think that several things contributed to this. One, we simply became hubris-ridden. 2, in the US economy, we built up too much debt. There's $36 trillion in on-balance sheet liabilities at the federal level. That's a T. And the net present value of unfunded liabilities, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number, the net present value, not the nominal number, is $100 trillion. To put that in perspective, the IRS says the private net worth of Americans is $141 trillion. So if you're worth 141 trillion and you owe 136 trillion, you begin to see the problem. I think investors, bond investors, have figured out that the only way out of America's dilemma is to reduce the purchasing power of the US dollar. Hence, they want more current yield to, in some way, shape, or form, recoup some of the losses that they will experience from the depreciation of the purchasing power of the dollar over time in their bond yield. And foreigners feel the same way. While the US dollar was, and US treasuries were the undisputed king of global trade mechanism for 40 years, while we will continue to be the world's reserve currency, we won't have the same dominating force that we had in the past. Very recently, yields, both real and nominal yields, have gone up in Japan. There was a trade for 40 years, a carry trade, where you bought artificially depressed, you borrowed in artificially depressed yen, and you invested in US dollars. That trade's unwinding as the Japanese interest rates go up. Hence, the Japanese yen is increasing. Renminbi is increasing. What we're seeing is a reduction in US hegemony, and we're seeing a change in market condition from the market that existed in the period 1982 to 2022 to a very different circumstance, one that's much more challenging. The Brits lost control, in effect, of their capital markets when George Soros and Jimmy Rogers and all those guys staged the famous raid on the British pound in 1990. I wonder, it could be that the Chinese, because of their savings, control some aspects. And we probably could have controlled our bond market if we weren't such profligate spenders. The world wanted US dollar hegemony. The world wanted the US Treasury to be a good deal. The world did not want the US government to try to extraterritorially impose US power in other countries through the SWIFT banking system. Whether or not the world liked the actions of Russia in the Ukraine, other societies looked askance when the US government stole $300 billion worth of Russian assets in US treasuries. It didn't give other people who thought that they might have a dispute with the US government much confidence in the security of their US dollar holdings. So the circumstance that we're going through, while interesting, was easy to see coming. With the obligations that the US government has, there are two ways out. You can have an honest default. That takes you right straight to the 1930s. It's pretty ugly. Or you can have a dishonest default. And that's what we're going to do. We're going to have a dishonest default. In a dishonest default, you honor the nominal value of the obligations. You tell some old geezer named Rick Rule, yeah, we promised you $4,000 a month in Social Security payments, and you're going to get it. It's just that we're going to devalue the dollar. So your $4,000 is going to buy you $800 or $900 worth of goods and services. Becky, we did this in the decade of the 70s. According to the Congressional Budget Office, the US dollar lost 75% of its purchasing power in 10 years. And I think that's what we do today. Yes, we fiddle around the edges. We look at Social Security and we say to some rich guy like me, we're going to means test it. Because you don't need it, you're not going to get it. And we're going to raise the eligibility from 65 to 70 or some number like that. That makes perfect sense too. When Social Security was instituted, the average life expectancy of an American male was 66 years. So we insured him for a year. Now the average life expectancy of an American male is something like 81 years. So we got to raise the eligibility. And we're going to axe the cap, which is to say rich people, despite the fact that they aren't going to get paid, are going to pay tax on their full income rather than the first 160. But that's not enough. It doesn't matter fiddling around the edges. What we're really going to do is what we did in the decade of the 70s. We are going to devalue the US dollar. We're going to reduce the purchasing power, and we're going to reduce it by a lot because we have no second choice. Let's do that original math again. As individuals, we Americans, according to the IRS, are worth $141 trillion. We owe we owe 36 trillion to bondholders, and we've promised $100 trillion to entitlements beneficiaries. That doesn't leave much margin, 141 minus 136. But it gets worse. The on-balance sheet liabilities of the US government grow by $2 trillion a year, and the off-balance sheet liabilities grow by $2 trillion a year too. This is decidedly bad arithmetic. And the only way that you do it is by sleight of hand, by reducing the value of the denominator, by reducing the purchasing power of the US dollar, precisely what we did in the 1970s. So I think in answer to the question, stagflation is very likely. I think collapse is unlikely, although I would be surprised if in the next 10 years we didn't have a liquidity event that reminded us of, say, 2008.
So here's where that leaves us. The US isn't planning to default by missing payments. It's doing something far more deceptive. By quietly destroying the dollar's purchasing power, they're meeting every obligation on paper, while robbing savers blind in real terms. Rick Rule calls it a dishonest default, and it's already draining the value of everything you've worked for. The only defense? Understanding how this system really works, and positioning yourself before the next wave hits. Now that you know how they're using inflation to pay you in monopoly money, you'll want to see what's coming next, because the next video on this channel will show you exactly how this financial endgame unfolds. Don't miss it.